Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is October 12th, 2023, and we're going to look at inflation will not die, but it may kill the market. As we're looking at this, we're going to talk about a couple of things with inflation specifically. Last week we talked about the idea that we are setting up from a multiple level, multiple factor view that the market is replicating or duplicating what we saw in 2000 with the dot-com bubble, the tech bubble, that we're sitting on another tech bubble now. So the market is being lifted in the technology sector, almost exclusively lifted in the technology sector, and holding the market up from falling. But we saw a little bit of a break, a little bit of a head fake in the market today after the bond auction. Today, CPI was released as well. CPI came in higher than we expected, and we're going to get a little bit deeper into some other inflation data. To start with, let's go into the CPI report. And to keep this simple, we're going to highlight just two or three things, and then we'll get into some more detailed information. First off, this is CPI adjusted over the year. You can see the individual month, 0.4 for September. You can see the unadjusted 12 months ending in September. And it came in at 3.7%. That is definitely hotter inflation than what we would expect or what we'd want to see in the market in conjunction with the rising rates trying to keep inflation in check. But as we're looking at this, I want you to scan down and notice why it wasn't higher. Why did we not see inflation data even higher? Because it was already at 3.7%. If you look down here, utility pipe gas service held it down by 19%. Realistically, if we took everything other than utility and pipe gas service, what would the number have been? And you can see there's fuel oil, -5, -3. It was really energy. So we do want to pay attention to the energy costs year over year. And in addition to that, just because the costs that they are tracking were negative on energy, did you see a drop in energy costs from a year ago? And what is that looking like as a percentage of your spending? And realistically, are we looking at a much higher number here? As you can see, used cars and trucks, -8%. That certainly held down the number as well. If you're not in the market for buying a used car, then that number doesn't matter to you either. There are a couple of different websites that I like to look at in tracking inflation data. And one is when we're looking at the old technique of calculating CPI versus the new technique pre-1990, post-1990. And also what happened to the actual purchasing power of the consumer. Not just what the numbers say in the CPI report, but how has this eroded the consumer's purchasing power. And you can see since 2020, from 3 years ago this October, the inflation data as far as impacting consumers, we have lost 20% of our purchasing power. Now it was worse, it was absolutely worse, 23%, but we're still at -20%. That means you can buy 20% less, 1/5 less of what you were able to buy just 3 years ago. And this is tracking the data and the purchasing behavior and the basket of goods that they believe that consumers actually are buying and what their dollar can purchase. And I think it's a better report. And you can see that during this entire year, we've been somewhere between 19 and 23% inflation when it comes to our purchasing power. I believe that that is fairly accurate in the numbers that I've read, and just in my own personal life, seeing what it costs to buy things at the grocery store, what things even on Amazon and discount sites cost, it appears to be that we are still facing inflation a lot larger than 3%. We're seeing 20% in the last 3 years. That's 6+% a year, and it was worse before. Now, this alternative under the shadow government stats, you can see they track a couple of different things, and they track CPI data the old way and CPI data after 1990. And then they also track this with some adjustment to inflation. As you can see, they have the numbers closer to 8% year over year in the post-1990, and the pre-1980 base CPI is what we used to use. We reached about 18% inflation. And as you can see, when we adjust for inflation, that is the highest the inflation has been, going all the way back to the 80s, back to the peak of inflation, the peak of stagflation at the end of the 70s, early 80s, that's where we're at. So this is the highest level we've been at. And that's using the traditional way, the old way, and from 1990 onward, you can see that this spike is the highest level in the last 20 years. So the inflation rate and the interest rate that we're dealing with, the interest rate's pretty high. The inflation rate is at the highest level it's been on the new format of CPI in over 2 decades. The inflation rate is the highest level according to their adjusted view of the government stats, going all the way back to the 70s. In fact, we are higher than what we saw at the end of the 70s, early 80s. This is a problem. Now, if we take a look at whether or not that inflation is going to impact the market, we need to know how is that impacting price to earnings ratio, because the market is a thing. A market is something, an asset that can be purchased with the dollar. So if the dollar's inflation is hurting the dollar's purchasing power, we want to see what that adjusted looks like in conjunction with the markets. And we're going to look at 2 different sets of data here as well. The first set of data that we're looking at is saying, hey, we had this spike up here. Let's ignore that move because the price to earnings ratio during the real estate bubble, that was way out of whack, super high up there. And we can say, okay, so we're not that bad. We're only at a PE ratio for the S&P up about 23, 25, somewhere in there. And so it's where we were at in the 2000s. It's where we're at in just a few months ago. And realistically, it's the highest level as far as PE ratios, price to earnings ratios, than we've been at any time prior to 2000. But let's adjust this for inflation. And just to show you, the PE ratio is still the same when we just leave it as the same from this other website. This is multipl.com, and it's just tracking. Now we're going to click on the Shiller PE ratio and get the inflation adjusted. As you can see, when we adjust for inflation, we're at the same level of PE ratios over price to earnings, based on earnings and based off inflation adjusted. We're at the same level we were Black Tuesday in the late 20s. We're almost double what we were Black Monday. We are not at the peak that we saw in 2000 with the dot-com bubble, but this is the S&P, not the Nasdaq, not the tech stocks. But we're near the previous highs that we've been at going all the way back to 2010. So we're just kind of holding up as a inflation-adjusted highest or some of the highest price to earnings ratios we've had since 2000. Otherwise, we don't really have much higher than what we're seeing here. So can this inflation destroy this? Are we overpriced even including inflation? It appears to be. What about the idea that if we correct, where could we correct to? Looking back to this, we saw that PE ratios dropped to 15 from 30. That's half. From here, from 45 to 15, that's 66%. And you'll see they're matching what we saw in the market pullback. After Black Monday, which was a horrendous time, look at that. We only went from 18 down to about 14, so maybe a third. Going back to Black Tuesday, the crash after the roaring 20s, we went from 30 down to 5. I'm not anticipating that, but could we go from 30 to 15 again, which would be a 50% correction with inflation remaining so high. Now, I would show you one more thing, and that is that our dividend yield is the lowest or near the lowest level it's been in history. In fact, we're at near these lows through here. When we saw those dividends hit, by the way, those are the low points. When the S&P is providing the lowest risk-free premium or lowest dividend yield, these are the lowest points before we see dividends go higher because it's price-adjusted dividend yields. So Black Monday was a low, Black Tuesday was low, 2000 was a low, and as we're looking at over here, we're near those lows, and we're only being offered about 1.58% dividend yield on the S&P 500, which means we're not getting compensated for risk, and this is usually and has historically been those points where we see a sharp correction in the 60s and the 70s and the 90s and the late 20s and 2000. So we're seeing, again, this inflation-adjusted return on risk-adjusted premium, showing that this is a point where we could see a major correction. To make a comparison with bonds versus the equities versus the dollar's purchasing power, what we want to do is let's go to the S&P since we're comparing to that, taking the tech stocks out of the picture. We'll leave our little head and shoulders and targets over here on the table. And what we're going to do is we're going to layer on a price ratio. We go to studies, edit studies, and put in the price ratio. The price ratio, historically speaking, they will always want to compare the cost of goods, services, or the market in this case, since we're talking about PE ratios and inflation. We can compare it to the S&P, or we can compare it to commodities versus bonds, and bonds being the risk-free premium. So a lot of times we would use something like gold or DBC, Deutsche Bank's commodity fund, as symbol 1, and then we could go over to the symbol 2 and say what would that look like if we were to compare that to bond futures. And I'm going to use TLT first, and we're going to change this in just a minute. DBC versus TLT. Hit apply, and anytime this number is high, that's high inflation. The ratio is saying, adjusting for a risk-free premium, how expensive are things, in this case, commodities versus bonds. And you can see we're near the highest level. We're the highest level arguably going back to 2011 on that ratio. If bond prices continue to fall, this ratio will become more dramatic. So as we're looking up back here, there's your 2008 super peak versus Deutsche Bank's commodities versus bonds. But let's compare to the SPY. The SPY as a function, or the S&P 500 as a function of bonds. But let's also not just leave it at bonds, TLT. Let's drop this to IEF. I'm a big believer that I know for a fact that banks use 7-year and 10 years for mortgages and for commercial loans. So we're going to use the 7 to 10 year bond prices versus the SPY. Now watch what happens here. When we adjust for equities, are equities overpriced when compared to a risk-free premium from IEF? Going back to 2000, we really can't even go back that far. Here we might try to push something back a little bit further, but notice 2007, 2008, we became overbought and rolled back down, crossed down, gave you a nice pullback from 2007 to 2009. That's an indication that equities are discounted and looking for the bounce and turn back up for an opportunity to buy. Notice as we pushed higher, that was 2007, 2009 pullback. We did have a little bit of a blip in 2014, 2015. As we get all the way up here, there's your 2020 pandemic lockdown. They're overpriced. We corrected down through here. And at this point, we're at 4.7 times. Compare that to 1.9. Let's just call it 2 times. So 2 times in 2007 said that the S&P was overpriced in comparison to a risk-free premium position such as a bond. As we're looking over here, we are seeing prices push up to these higher levels, and as a multiple, we're 2.5 times higher, almost. 2.5 times higher than this bubble. So if inflation is remaining high, if the dollar's purchasing power is remaining impacted by these rising rates and the rising inflation, yes, the dollar may have higher purchasing power against other currencies, but not as far as what we're seeing in the S&P 500. So the S&P 500, the PE ratio adjusted for inflation is near highs. Dividend yield is at near record lows since the inception of the S&P 500. And we're seeing that the price to a risk-free premium is at a peak that we have not seen at least in the last 20 years. Now, what's the timing? Well, we could wait until we cross down or cross through this yellow line. We know that we've created a lower high and a higher low. So we have consolidation on the month-to-month. This is the maximum time we can see. And so monthly candles, we know that we're at that level. If we go into the shorter time frame, we can still see that bigger, longer-term consolidation. We did create that head and shoulders. This bounce is coming back up to test some previous lows, possibly the neckline. But as this sets, we are looking for a bearish move to adjust for inflation. We didn't even get into the idea that high inflation is going to continue to impact demand, impact earnings, impact prices across the board. So if inflation is driving prices higher, but earnings are not going up anymore because consumers have 20% less to spend from just 3 years ago, then that inflation is going to impact behavioral economics. That inflation is going to impact earnings, and we're going to see the price to earnings ratio correct. Because think of it this way. If we're seeing earnings slide and price continue to move, that's inflation driving prices higher and earnings falling. That will become even more dramatic price to earnings and having even larger area to correct to. If inflation remains high, it is worth noting what happened in 2007, 2008, 2009 when it pulled back before. That gold prices, I'm on a weekly chart now, but gold prices continue to climb as inflation held while we had disinflation in the housing markets. So gold prices was a flight to safety, a store of wealth, a store of capital through here. Like we talked about in 2015, we stabilized in gold prices there, 2015, as we rolled back down. So it didn't act as a run up, but it certainly acted as a safe storage of money or wealth, and gold traded flat almost 6 years through there. And so as we're watching this, gold could hold up. And you know I'm not a gold bug, so gold could hold up for a while we're watching to see if inflation is going to correct, if the market's going to pull back, and if we start treating gold as a safe store of money. Lastly, let's take a look at carry. And looking back again, there's your peak, there's your sell-off, 2007, 2008, 2009. And you'll notice this chart here mirrors this. Look at the difference between the SPY and bonds. And look how similar the pullback, the lower highs, the lower lows, the base almost to the day, the climb, the bounces all the way through, the spikes, the corrections, how these all seem to mirror what we saw in the price ratio between bonds and the SPY. As we're looking over here, and I just changed this over to the ZN, so we're looking at the current bond prices. And you can see that we pushed higher through here, and yet KRE has already started moving. This is a divergence of price action. KRE is leaning lower, and we may have already seen the breakout and the correction through here. So watch for a breakthrough support and a continuation lower with the regional banks as we're setting up for this correction through here, and then these should get back in line. That's going to do it for me today. Have a great day, everybody. We'll look forward to talking to you again.